Good morning, everybody. Scott Mabor here with your Medicare Missive from the pond for Thursday, the 9th of April. Hope you are all doing well. Today I wanted to talk about actually a new product, a different product. It is a Medicare product unlike anything I've seen before. The one caveat is it's available in all 50 states, but you have to be either self-employed or it has to be offered by an employer. There's no cost to the employer, so it's something that they could offer. So if you control a firm or have a close relationship with your boss, this would be a great thing to offer because it's another option for Medicare eligible employees that ultimately saves the company money by getting the 65-year-olds off the health plan. For those of you who are self-employed, and it doesn't have to be full-time and it doesn't have to be your primary source of income, but if you have a side hustle, mowing lawns, delivering newspapers, doing taxes, whatever it is on the side, that works also. And what this plan is, or how this plan works, for those of you familiar with a health savings account in the under 65 world, this is a Medicare savings account. So this is for those who are 65 and older. You have to have Medicare A and B from the federal government. And then you sign up for this plan. And the way the plan's going to work is you're going to pay approximately the same as you're going to pay for a Medigap plan. So, and it's adjustable. You can pay more if you wanted to. And I'll explain quickly why. But it has a side savings account. So a portion of your premium every month goes into the savings account. The federal government matches that. So up to $200 a month, you're getting an additional $2,400 from the government into your account. And that goes January 1st, prorated if you sign up in the middle of the year. But if you sign up January 1st, you're going to pay your monthly premium. Portion of that goes into the savings account. January 1st, $2,400 goes into the savings account. So it's a high deductible plan, just like plans with the HSA, except you're already getting nearly half of it in cash on day one. So if you choose the $5,000 option, you're getting $2,400 on day one. So half of it nearly is covered already. Then your premiums are going towards your deductible. The majority of your premiums go towards your deductible. This money in the savings account is yours. You spend it however you want. You get a debit card. It's your account. The theory is you're putting the money in there tax-free. As long as it's used for qualified medical expenses or long-term care premiums, it gets used tax-free. And the growth on it is tax-free. So whether it's interest or investment, that's all tax-free. Now, can you make a car payment with it? Can you go buy a boat with it? Absolutely. It's your money. You do whatever you want with it. But if you use it for non-medical, you'll have to pay taxes on it. But it's there. It's a nest egg. It continues to grow and it rolls over each year. It's a phenomenal plan, especially if you're healthy. So, currently healthy and you figure, great, I have some good years ahead of me. Let's build up a nest egg for future needs. Perfect. There is no network. Beyond the deductible, there are no copays. So you can see any doctor. Once the deductible is paid off, you have no copays. And you can use the money in the account to pay copays pay the premium copays until you've met the deductible, or you can take it out of pocket and let that money sit and grow. Totally up to you. The reason I say you have a variable deductible is because you could pick a higher deductible. And if you have the income and you have the cash flow, the income, and the need for a big tax write-off, you could pick a $16,000 deductible instead of a $5,000 deductible. And when I first saw that, I thought it was crazy. Why would anyone take a $16,000 deductible? But now you're paying $1,500 a month. Most of that, $1,450 of it, is going into a savings account every month, tax-free for you, for your spouse. At the end of the year, plus you still get the $2,400. If you've used nothing, you still have a $15,000 deductible, but you have $22,000 in the account. So even if you max out that account and you have to pay $16,000 on December 31st, you still walk away with tax-free $7,500 earning interest and rolling over. And then there are steps in between the two extremes that I mentioned. It's a phenomenal plan. I've never seen anything like it. I have several people using it with great success. It takes a while to wrap your head around it. I've spoken to a lot of brokers about this who want to input it, plug it into their groups to encourage people off the group plan. Just a phenomenal option. Never seen anything like it. Very cool. Takes a while to understand and wrap your head around, but if you have questions or you want information, please reach out. Thank you very much. Look forward to speaking to you. Have a great day. Thanks for watching.